videos on. Thank you. Yay. It's really nice to be able to see some of your faces. Um, Thanks for joining us this morning or this afternoon now. This is crazy. It's the last live session for FR for this course. I'm sure it's flown for you. And I can't believe it's come to the end of the year already. 2 weeks until final exams, which is pretty intense. Still some time to get ready, but also just like the final stretch, which is it's at the same time feels good that it's almost over, but also kind of like, oh no, crunch time, got to really put in the hard miles. So I hope you're feeling strong. I hope you're feeling ready for the next 2 weeks. Just give it what you've got. Today's session I don't think is going to be particularly long. If you've had a look at the leasings material, you'll know that it wasn't like a full topic. I will just kind of talk about some high level stuff, some real world application, why it's important, and obviously give you a chance to ask any questions that you may have. Before we get to that though, a couple of quick announcements. Firstly, the test 2 feedback is available. So you'll have your test 2 marks and you have your scripts and your mark plans available. And now Miriam's also prepared some feedback about the question. So I would highly recommend taking some time to work through that question again, both of the questions of test 2, having a look at the suggested solution, having a look at the feedback that Miriam has prepared about that, which includes comments from the markers about things that they saw coming through quite commonly, and then also looking at your solution and how you fared in that question, and take away from that what you think you could improve in order to get better in the test or the exam. Excuse me, I'm just a little bit confused. Anyway, let's see who's okay. The bridging FR discussion group is joining the meeting. Anyway, we'll see what that means. My point there is take away what you can learn from test 2 in order to succeed as best as possible in the final exam. So last opportunity to really take that test, see how you did, see where you could have improved, give yourself a pat on the back for things that you did well, where your exam technique really helped you, and yeah, make some final little improvements and tweaks for the final exam. So as we said, the final exam is like 2 weeks away, so you've got study break until then. I would strongly advise that you plan the time that you have now in the study break. So don't kind of just take it as it comes. I'm a planner in life in general, but I think that this is a point in life where it definitely pays off to be a planner. So think about what you need to get through for each of the 4 subjects when you're going to focus on each of those topics. You don't have time to go through everything for all the subjects again. You simply just don't have the hours available. And certainly if you're still working through this time, you're not going to be able to do everything again. So you need to be selective about what is most important in each topic and in each subject, and touch on the things that really need attention for you. And that's where you need to know where you are weak and where you need to improve. And then feel confident in your ability, where you feel like, I've got something. I don't need to go back to understand, for instance. Perhaps you feel comfortable with assets and PPE and intangibles and how those are accounted for. It is a big section, so you don't want to spend a lot of time going through it. But if you feel confident, then don't force yourself to spend time on that. Rather focus on the areas where you feel that you need to give some more attention. So my encouragement would be to really plan your time for the next 2 weeks and include a little bit of rest just before the test. You don't want to go into the exams exhausted. You want to be mentally rested. You want to be physically rested. And it's 4 days of writing, which is heavy when you have to sit through that level of assessment setting every morning. It is going to be quite demanding. And so you don't want to go into that exhausted. So if you can, take that Sunday off before you start writing so that you are able to rest your mind, accept that what is not in your brain by the end of Saturday is not going to get into your brain in time, all right? And remember, you don't have to get 100%. It doesn't have to be perfect. You just need to do enough to pass and to get what you need to be successful in the program. So you're not aiming for perfection, you're aiming for it to be good enough, to be strong enough, and to have your confidence with you as you walk in. And being rested is part of that. It also, being rested gives you emotional capacity. If you feel a little bit thrown or a little bit blindsided by something and you're tired, that can totally wreck you. But if you're well rested, you can have some perspective on that and say, okay, look, this, I don't know what's going on here, but it's for 5 marks. I don't need those 5 marks. I'm just going to move on and get the marks that I can get. And you can cope with it and take it in your stride a bit more. So being well rested is also part of being well prepared. So my encouragement is make sure that you work hard, but also make sure that you are realistic about getting some rest and going in feeling strong and confident and having your own back, positive self-talk. Yeah. And then also one final encouragement to consult before the exam. So if you're working through questions, if you're working through the test, if you're looking perhaps at some live sessions again, if you think that's going to be helpful for you, whatever it is, I would encourage you, if you have a question, to use whichever method of communication with the lecturers is best for you in order to clarify questions. That might be email. Perhaps it's just, email's great because you can send it as soon as you think of it. It doesn't matter if it's 2 o'clock in the morning and you know that you'll get a response fairly quickly. Perhaps you prefer to talk face-to-face and you want to book a consultation in person, then you may have to wait a little bit until you can get that session with the person that you want to speak to. You can post in a forum. That's helpful because then if other people in the program are kind of dealing with the same issues, they can contribute, they can benefit from the answers as well. But use whichever one you prefer in order to get the answer. The worst thing that I see with students is when they think that they've worked out the answer for themselves, but they've actually gotten to the wrong conclusion. And in some question, maybe it hasn't been 100% clear. There was a student who posted in the forums this morning who had worked something out for herself and then posted the question and the answer and was just asking for clarification. And I thought that was great because I was able to tell her, yeah, you got it right, on the right page. This is the reason why, this is the correct conclusion. But if someone had gotten to the wrong conclusion, it would have been an opportunity for me to make sure that they didn't have the misunderstanding there. So use all the tools at your disposal in order to clarify any questions which you may have before you go into that test. Just, we always have those areas where we're like, oof, I hope that doesn't come up. That part of revenue, like it's not quite clear, or that thing with financial instruments, I hope it doesn't come up. If you have any of those, best to just clarify it. And if you can't express your question, then a consultation face-to-face is a great way to discuss it with the lecturer and kind of talk through it together and find some clarity. All right, so that's kind of my encouragement for the next 2 weeks. If you have any other questions, feel free to ask those, to post those. Yes, and say for positive self-talk is good. Okay, big difference. I don't know if you guys have heard about the study. It was a few years ago that they found that people who stood in superhero poses, I know that sounds bizarre, but if you stood in a superhero pose, you know, like I've got your fists on your hips and you like stand with your chest out. So if you do that for a few minutes before you write a test or exam, it actually builds your confidence, and it made a statistically significant difference on people's results in their performance in a task, as if they had just had like positive posture and self-talk. So I know that we think of those things as maybe not making that big a difference, but that frame of mind can really make a big difference as you go in. And then one final request from our side. You would have seen Gareth's announcement on Friday about student feedback. We'd love to hear feedback from you. I'm sure you're aware this is the very first time we've run the program. And so there are definitely areas in which we can do better, and the areas in perhaps we're doing well, and we'd like to know what those are. So please take a moment to give us feedback. I don't think it should take you more than 10, at the very most 15 minutes if you really want to write lots of personalized responses to the lecturers. But that's your opportunity to get feedback on the program as a whole, on each subject, as well as on each lecturer. And that's helpful for us to know how we can improve going forward, because we really do want to be the best course that we can be. Okay, so that's all from the announcements perspective. let's move our attention over to leases. As I said, we're not going to spend a huge amount of time talking about it because we're just really looking at the key aspects of IFRS 16. So if I show you this overview that we had in our material, it was kind of just a high level summary of what we looked at in IFRS 16. So IFRS 16 is a massive standard. If you've had a look at it, you would have seen that there are a lot of paragraphs, there are a lot of things that we haven't discussed in terms of all bunch of things that go on in the standard. And in PGDA, we'll get to a lot of the things that we've excluded for the purposes of this course. But there's also stuff that we won't even look at in PGDA. It is an enormous standard. Leasing is a very prevalent thing in practice, and many companies are either lessors or lessees, and so they need to account for leases in some shape or form. And that's why this is a very important standard. It's very widely used, but it's also a brand new standard. So it became effective at the beginning of last year, I think it was. And so we are seeing companies having to implement this standard, and that makes it quite topical as well as you go into PGDA and as you write the board exam. What we are focusing on is just kind of the basic accounting for lessors and lessees to lay the foundation as you go into PGDA. You may not have seen this before. Perhaps in your previous studies, you saw IAS 17. That was the previous leasing standard that has now been replaced by IFRS 16. If you were familiar with IAS 17, you would see that the accounting that it uses is still applicable for a lessor. So the lessor's accounting has not changed in IFRS 16, but we've seen a significant change in how a lessee accounts for a lease. And that means that lessors and lessees are using different approaches to accounting for leases. And so we won't have the asymmetry between the accounting on the financial statements of the lessor and the lessee. Let's have a quick look at what we have for each of the each of the members in a lease. Starting off, this very first question of, do we have a lessor or a lessee? I'm sure you can see it's pivotal because we have this complete dichotomy of how we do the accounting for the two. That it's pivotal that you understand which side of the transaction each of those are standing, and you need to determine who is who. So starting off with the lessor treatment, which we said has carried over from IAS 17, only for lessors do we distinguish between finance and operating leases. So a finance lease would be one where all the risks and rewards of ownership are transferred to the lessee, and an operating lease is one in which that is not the case. So they remain with the lessor. So in a finance lease, and remember there are these paragraphs that give us guidance on distinguishing between a finance and an operating lease. With a finance lease, we are saying that the risks and rewards of ownership associated with the asset have transferred. So essentially, we're saying that although we haven't legally sold the asset, although we haven't transferred it in the legal sense, we've given away the substance of the rights and rewards of ownership in terms of this lease, and we've given that to the lessee. And so from an accounting perspective, remember, we think about substance over form. We're not concerned with the legal structure. Just because we're calling it a lease, in substance, we've given away the real core benefit of ownership to the lessee, and therefore we need to de-recognize the asset. So the actual asset is de-recognized. But what we have instead of that is now we have a right to receive the lease payments. We have the right to receive whatever the lessee is going to pay us over the lease term. And that essentially is similar to a trade receivable. It's a debtor. We have a person who owes us money. And so that's what we recognize. We recognize this thing called a net investment in the lease. And we do that by recognizing a gross investment in the lease and the unearned finance income, which net each other off and give us the net investment in the lease. So it might be helpful to think of the gross investment in the lease and the unearned finance income as in some ways similar to the cost and the accumulated depreciation accounts associated with an item of PPE. So if you have PPE and you have the original cost of the item, that sits in one account. And then you have the accumulated depreciation and impairment, and that sits in another account. But to get the true carrying amount of the asset, you put those two accounts together, and then you get the carrying amount of the asset. The same is happening here with the lessor finance lease accounting. We've got the gross investment in the lease. We've got the unearned finance income, which kind of takes into account the time value of money. And when you put them together, they offset each other slightly, and you get the net investment in the lease, which is the actual carrying amount at the reporting date of that receivable. Now, we did talk a bit in the lessons about leases of lands and buildings. When we lease land and buildings together, we need to separate out the land from the building, because land can never really be a finance lease, because remember, the rights, the risks and rewards of ownership of land can only transfer if we transfer title. So you can have a finance lease if there is going to be a transfer of the ownership of land, but because land is not used up, any lease term would essentially not transfer those risks and rewards of ownership unless we have a very long lease term. And we spoke about like 99-year leases and such. So typically, if we're looking at a lease of say 10 years, for the building, it may be a finance lease, but for the land, it would be an operating lease. And so we'd have to split those out and account for them separately. Now, if a lessor doesn't have a finance lease, or doesn't have a lease in which the risks and rewards of ownership are being transferred, then what they have is an operating lease. And an operating lease is much easier to account for. The asset will remain on the statement of financial position and will continue to account for it appropriately. So it might be investment property, which you would account for with the fair value model, or the cost model. It might be PPE, where we would use a cost model or the revaluation model, but we would account for the asset as we would. But what we'll do is we'll just recognize the income related to the lease, so the lease income over the lease term, and that would be straight line. So when we talk about straight lining, what we're talking about is taking what you receive over the entire lease term and essentially finding the average. So if the payments are not the same in each year, you'll have to take those contractual payments and find the average of them and recognize that over the lease term. So each year, you'll recognize the same amount of income, although the cash flow may be different. And then you'll have either an asset or a liability kind of settling that journal entry that you recognize with regards to your operating lease. And over the entire lease term, whatever is recognized in the statement of financial position will kind of come out in the wash. So at the end of the lease term, it comes back to zero. Okay, so that's lessor accounting. We've got the distinction between finance and operating leases. It's kind of more of an old school approach. So if you've seen leasing before, that's probably what you've seen. With the lessee accounting on the other side, that's entirely new with IFRS 16. So taking it from the lessee's perspective, we see we have this very key journal entry, which happens at the date of initial recognition. So what happens now, instead of a lessee thinking about operating and finance leases, they don't think about that at all, okay? They just process this journal entry. And they will process that journal entry for just about every single lease that they enter into. The reason that I say just about is because there are some exemptions, and we'll talk about the exemptions just now. But that journal entry is really the general rule, the general process that lessees will use in order to account for their lease at initial recognition. So what we'll do is, as a lessee, we'll first determine what the lease liability is. So that's the obligation that we have to make payments. So remember, we said that a net investment in the lease was the right for the lessor to receive payments. It was like a trade receivable, so debtor. Okay, now that we're on the other side of the transaction, the lessee has an obligation to make payments. So that's what the new IFRS 16 is trying to get all lessees to recognize, is that obligation, because that's helpful for users of financial statements to understand that obligation that companies have to make payments, because before those may not have been on their statement of financial position. And we'll have a look at an example of that just now. All right, so they measure the lease liability, and we've got this three-step process to measure the lease liability. First, we determine the lease term. Okay, remember that's the non-cancelable portion of the lease adjusted by any reasonably certain termination or extension options. So first, use the information required to determine what the lease term is. If a termination option or an extension option is considered reasonably certain, it will be included in that lease term. If it's not, it'll be excluded. Okay. Then identify the lease payments, and remember that there are a number of types of lease payments. So there are fixed lease payments, which are the ones that are easy to identify. Excuse me. Okay, those are just the fixed payments are just the contractual payments which have to occur every period. There's also something called in substance fixed payments, which we said were variable payments dressed up as fixed payments. I'm sorry, fixed payments dressed up as variable payments. They look like variable payments, but they're actually unavoidable, and that makes them in substance lease payments. We spoke about variable payments that are linked to an index or rate, and we spoke about guaranteed residual values. Those would all be considered lease payments. So you can have a look at a list of what lease payments are in paragraph 27. You can also see it in the definition in Appendix A of the standard. Now remember, anything that is genuinely variable is not going to be included in the lease payments. What we're looking for here, remember, is the obligation that the lessee has to the lessor. Anything that is genuinely variable is avoidable. Okay, we might not intend to fully avoid those payments, but if it's genuinely variable, we have the ability to avoid it. And therefore, it's not going to be part of that, that obligation that we recognize at initial recognition. Okay, so then once we have our lease term and we've identified what falls into the category of lease payments, we apply the correct discount rate to get our lease liability. Now, the discount rate, if we can use it, if we can calculate it, is the interest rate implicit in the lease. That again is defined in the appendix, and it's a definition worth having a look at. The interest rate implicit in the lease, though, requires some information that the lessor may only have access to. And so it's quite conceivable that the lessee would not be able to calculate the interest rate implicit in the lease. And then if that is the case, then the lessee will use the incremental borrowing rate, which is the rate that they would have to pay if they were to borrow the money on exactly the same terms, essentially, as what's happening with the lease, for the same asset over a term that is equivalent to the lease term in the same economic climate, etc. That would be the incremental borrowing rate, and that's what they'll use if they can't get the interest rate implicit in the lease. That will then give us a lease liability. Now, the lease liability then determines the amount at which we recognize the right of use asset. There are one or two small adjustments which may happen to the right of use asset, which mean that it may not align perfectly with the lease liability. For instance, if there is a lease payment at the inception of the lease, at the very start, that would be included in the right of use asset, but it would not be included in the lease liability because there's no future obligation. It's been settled because it's been paid. But typically, once you have the lease liability, you have the right of use asset as well. And so these two kind of are married at initial recognition. They are joined together. They're recognized at the same amount, and then they go their separate ways after the date of initial recognition. So the lease liability after initial recognition will be amortized, and the right of use asset after initial recognition will be accounted for in terms of the cost model. Now, it may be helpful to link these treatments that we have for the lessee to some of the accounting that you've seen before. So this initial recognition of the lease, in many ways, is similar to what you've seen with accounting for provisions. So think about provisions where we have this obligation, uncertain timing or amounts is what a provision is, and you find what that obligation is in future, and then you will discount it at the correct rate, which is normally kind of the prevailing market rate, to get the present value that needs to be recognized at initial recognition. And that is similar, very similar in process to what we're doing with this lease liability. It's an obligation, like a provision. There is some uncertainty because we aren't exactly sure what's going to happen. These are estimates. Our lease term, our lease payments, these are all our best estimates, okay? And we apply a discount rate to account for the time value of money. So that initial recognition of the lease liability is very similar to what you would have seen with the initial recognition of a provision. Then the subsequent treatment of the lease liability, which is amortization, is exactly the same process as what you saw in terms of IFRS 9 with our financial instruments. So we saw how to amortize both a financial liability and a financial asset. Because we're looking at a liability, I suppose this is more similar to the amortization of a financial liability, but it's exactly the same process. So it's a similar concept for you to apply to the lease liability. And then finally, the treatment of the right of use asset, that is essentially the same as what you've seen as accounting for PPE on the cost model. So we will amortize that or depreciate that right of use asset over its useful life. And eventually it will come down to zero at the end of the lease term. So these are all approaches that you've seen before. We're just kind of putting them together in a new way to account for leases. And finally, we mentioned the exemptions that we have for the lessee. So the exemptions apply to when we have short-term leases, so leases of less than a year, less than 12 months, and leases of low-value items. And remember, those are low-value items new, and that's not related to the materiality of the company. It's meant to be low-value items across the board. So the things that we're thinking of here are like small electronic devices, things like laptops, computers, water coolers, telephones, things like that, that the company may have hundreds of, and it may lease them, but it doesn't need to account for leases for each of them and have this onerous lease liability calculation for each of them. Instead, what it kind of does is something very similar to what we see with the operating lease treatment. They'll be straight lined in profit or loss over the lease term. And so it'll just have an impact in profit or loss rather than having an impact on the statement of financial position. So the only impact we'll have in the statement of financial position will then be the effect of any straight lining that is necessary. Okay, everyone okay with that? Any questions? Let's have a look here at messages coming through. Go into a bit more detail of how we choose a discount rate. Okay, so around choosing the discount rate for the lease liability, which is what I presume you're talking about, Masehu, is there is actually no option. Okay, so if the lessee can calculate the interest rate implicit in the lease, they must use that. Okay, so the two options here with the discount rate are option one, interest rate implicit in the lease. Okay, and that is a defined term. So you might want to go have a look at that in the definition. And as I said, that takes into account the lessor's initial direct costs. And it also takes into account any unguaranteed residual value which the lessor has assigned. So that's information that the lessor has that the lessee may not have. And that's why a lessee may not be able to calculate the interest rate implicit in the lease. If you think about it from a math perspective, it's essentially the discount rate that the lessor has used in pricing the lease. So remember that the lessor would have done a calculation to work out how much return they need from the lease, and the discount rate that they require as return, that's what the interest rate implicit in the lease is. Now, in some situations, perhaps the lessee and the lessor have a good relationship, and the lessor openly discloses that rate to the lessee. Then, if the lessee knows that rate, they must use it. Or perhaps the lessor communicates to the lessee what the unguaranteed residual value is, what they expect the asset to be worth at the end of the lease, although that's not being guaranteed by the lessee. As well as their initial direct costs. So if the lessee has the information and they can calculate the interest rate implicit in these, they must use that, okay? However, if they can't use that, and in most situations, the IASB expects that the lessee will not be able to calculate the interest rate implicit in the lease, then they use the incremental borrowing rate. Incremental borrowing rate. Okay, sorry, my handwriting is not super neat on this little board. So the incremental borrowing rate, just to refresh, is the rate at which the lessee would be able to borrow money, say from a bank, if instead of leasing, they were to buy the asset. So instead of leasing a piece of equipment for 5 years, if the lessee borrowed enough money to buy the equipment, how much would the bank require in terms of an interest rate of compensation? That is the incremental borrowing rate. And so in many, many cases in practice, we will find that the lessee will have to use the incremental borrowing rate because they can't get to the interest rate implicit in the lease. So hopefully that answers your question there. Oh, okay, and then another question. Does low value depend on the entity, like one company's value may not be the another? Okay, so great that you're asking about low value items for the exemption. It does not depend on the company. Okay, so whether you're Microsoft or Google or like one of these massive Amazon, whatever, if you're one of these enormous companies versus if you are an NGO in the backwaters of, I don't know, somewhere in the Western Cape, and like no one's ever heard of your NGO, but you're both using IFRS 16, you should come to the same conclusion as to what a low value item is. It's not at all dependent on how big the company is. It's not at all dependent on what is material to a company. So for a small NGO doing work in rural Cape somewhere, for them, a laptop may be a huge investment because it's 20,000 Rand or something for their operations, but it's a big investment in terms of their company. Whereas you think like an international corporation, they probably buy hundreds of laptops a year. It's like they don't even think about it, okay? But a laptop overall is considered a low value item. So what the board put in the basis for conclusions is they said things in the region of 5,000 US dollars. That anything below that they would consider, that's what they had in mind as a low value item, which for us is quite a lot of money. I mean, what is 5,000 US dollars? I don't even know what the exchange rate is. It's probably about 16 Rand at the moment. But that translates to a lot of rands, okay? So that's kind of what they mean. But what they're trying to do is they're trying to distinguish between, say, a vehicle or a building and a cell phone, okay? And so you don't have to apply the leasing to each of those items the same way, that you can get a bit of a break and a bit of relief for preparers when you're talking about smaller items. Okay, so correct, low value is not company specific. It's meant to apply for everyone. Okay. Next question. Okay, I'm glad you understand, Stefan. Awesome. Exemptions for lease term greater than a year. Do you mean less than a year? Okay, because the exemption is for short-term leases. So it's leases less than a year. Do we take into account the materiality of the lease value? I'm going to assume you're referring to short-term leases there. No, the materiality of, yeah, okay, cool, less than a year. The materiality of the item that you're leasing is not taken into account. So there it's just because it's less than a year. If it's a building, if it's a vehicle, if it's a warehouse, if you're only leasing it for a year, you can apply that exemption. So presumably it'll only affect one reporting date anyway. And so the obligation being on the statement of financial position for that one reporting date, it kind of the assessment by the ISB is that the value to the users of the financial statements to be able to see that obligation for that one reporting date is not justified by the effort it would require for the preparers to go and to do the work to recognize the lease liability. And that's why they provided relief for short-term leases. Okay, so that's also not got to do with materiality. Okay, before we close out here, let's just have a quick look at this article. I sent the link earlier, but I'm not sure if everybody got to see it. Let me see if I can send it again if you want to check it out afterwards. But essentially, this article talks about how for Pick and Pay, the impact of accounting for IFRS 16. So as you said, the standard recently came into, oh, I've lost the word. became applicable, that had to be enforced and applied. Sorry, my brain's just gone blank. So Pick and Pay, you can think as a company with many stores around the country, but they don't own all of the buildings that they are in. I don't even know if they own any of the buildings. They probably own warehouses and stuff, but for the retail stores, often those would be in shopping centers or malls or whatever. And so they've rented the space in order to sell their products. And so what happens now is that they had to implement IFRS 16 as the lessee. So they're sitting now on this side with as lessees in the transaction, and they now have to go and recognize all of the lease obligations related to the leases that they are part of for all of the space that they have leased for their stores. And what we can see is that it went up. Their obligations, their debt went up to 17 billion rand from only 1.6 billion rand. Now, this shows us exactly why IFRS 16 was necessary. Okay, if you are an investor or a shareholder in Pick and Pay, that information of the obligations that they have in terms of their leases is hugely significant to their business model because they lease so much property. But when we only had 1.6 billion on their statement of financial position, we couldn't see what that obligation was. Now, IFRS 16 says, no, Pick and Pay has signed all of these contracts. They are liable to pay the rental. And so they have to show that obligation on their statement of financial position. And now we have this enormous, more than 10 times increase in their debt, up to 17 billion. And so it says here, 1,600 leases that they have. And so that's really an enormous impact that we can see IFRS 16 having in a real world situation. And you can see if you have a read through the rest of the article, a lot of it is the analysts and the chief executive trying to explain that nothing has changed in terms of their business model. Nothing is different. They're just being forced to recognize on their statement of financial position things that weren't there before. And that's true. Nothing has changed. But they always had these obligations. The users of financial statements just couldn't see them. And so this enormous restatement, we'll see it also changes, it changed headline earnings. It had a deferred tax implication. It really had this knock-on effect to a number of things. But the substance, and what they're trying to say in the articles, the substance of all the agreements that Pick and Pay has not changed. And so the risk profile hasn't changed. So it's trying to encourage investors not to freak out and like sell their shares. There was a bit of an impact. I don't know if I have it here, but their share price did drop a bit. Here we go. The share price did drop a bit, but it's not as much as other retailers. So it seems that investors understood the impact was purely a disclosure impact, but it was very significant. And this is why we have IFRS 16 to help us. Okay. Any more questions from your side? Maseko, is the less than a year referred to your financial year or 12 months? It's 12 months from commencement date. So it doesn't need to refer to the financial year. I presume you're talking about the exemption. The exemption applies to all leases where the lease term is 12 months or less. So that also would take into account, remember we said that the lease term is the non-cancelable portion of the lease. Yeah, where we're determining lease term. It's the non-cancelable portion of the lease adjusted for any reasonably certain termination or extension options. So if you have, for instance, a termination option that's considered reasonably certain, and you take that into account for determining your lease term, and then you get a lease term that's only 12 months, then you can apply the exemption. So it really is just about having a lease term of 12 months or less. It's got nothing to do with the entity's financial year. Cool. Any other questions? Any thoughts from your side? Cool. Happy, Maseko. How are you guys feeling going into study break and facing the final exams? You normally have to rate your kind of comfort level with the knowledge in the topic. But why don't you give me an overall? How do you feel about FR as a whole at this point, going into the exam? out of 10. 10 is I'm going to knock it out of the park. I'm going to get like a distinction for the exam. Okay. Naught is like, jeepers, I don't even think I've done any work, but I know that none of you guys are going to be a naught. Okay. 5, 6. Cool. 6.5. In a sense that you couldn't quite decide between a 6 and a 7, so 6.5. 7.55. That's very specific. Okay, let's keep it to 2 decimal places. We won't go beyond that. Okay. Okay. Another 5 coming in there. All right. So you guys are feel in the middle somewhere to slightly confident. I'm really hoping that in the next few weeks, in the time that you have to prepare for final exams, you're able to lift those numbers a point or two so that you go into the exam with a good 7.5, 7.55 is great. Maybe an 8, 8.5, feeling strong, feeling confident. After test 2, I don't know how to feel. Well, positive self-talk. Tell yourself all the good stuff. Tell yourself all the reasons why this is going to go well and why you've got this in the bag. Okay, do the work, but also believe in yourself and build that confidence, because that really can't be underestimated. A lot of, even you find in practice, a lot of people who are successful are just people who have confidence in themselves and are willing to go for it and to give it their best. So I really want to wish you guys all the best. As I say, please do reach out if you want to consult at all. Oh, thank you for mentioning the practice pack. I meant to mention that. Yes. Would you suggest that we do the additional questions, or can we leave them for the last minute? I would suggest that you use them in the best way possible for you. Using them for the last minute or like your final little bit of FR work is probably a good approach. The way that my preference is with how you would use the practice pack is that you would use it once you have finished up your studies and you just want some fresh questions to practice, kind of sitting down, writing the exam and doing your exam technique. And just to use them to kind of exercise that muscle of writing an assessment. You don't need to do them all. You don't need to do any of them. Rather look at what topics are addressed in them and attack the ones that you think are going to be the most helpful for your learning. So if you feel like you want to practice a revenue or you want to practice financial instruments or whatever, you have a look at the ones that are going to be most helpful for you. I actually think there isn't a revenue question, but it's just because Gareth felt that what you've got with the revenue practice questions is really comprehensive. So you have enough there in that topic. No, they don't include every topic that you've covered, but they try and cover a range of topics. So I think there are only 4 questions, but they are integrated and they pull into, I think there's a groups one, there's one that's got more leasing, but it also pulls in other knowledge. As we saw, the calculation of lease stuff does rely on prior knowledge or pulls in similar treatments to what you've seen before. So it's not exhaustive in terms of covering everything, but they're just there to give you an extra resource to practice a little bit more. Yeah, so don't think that they're also a guide as to what is in the final exam, because that's certainly not the intention either. All right, any other questions? All right, thanks guys. All the best. You know where to find us if you need us. I really hope it goes well. Wishing you the best of luck and trusting for good news. And please don't forget to fill in the feedback if you haven't already. It can be a nice little study break when you need to have a break from your studies. But look after yourselves and we'll be in touch soon. Thanks so much.